Well, good morning, and thank you very much for inviting me here to Mumbai. I've already had a fascinating 24 hours learning much more about the Indian industry. So let me just tell you a little bit about myself and my business. I lead the wealth and asset management consulting business at EY. We have about 5,000 consultants globally that jump out of bed every morning thinking about your industry, helping wealth and asset managers really adapt to the changes that we see in the world. So let me just set the context before we jump into how artificial intelligence may help this industry. So on a global basis, this is an industry that is reaching an inflection point. And although here in India, of course, your industry continues to be extremely healthy, very strong returns, despite some short-term volatility, on a global basis, this is an industry that's really questioning the value for money it's delivering to the end investor. An industry that is actually experiencing a number of structural shifts, moving away from just some of the cyclical shifts we've seen in the past. And we believe we're entering into a period of unprecedented change as a wealth and asset management industry. So why do I say that? Well, of course, on a global basis, I'm very privileged to meet many different asset and wealth managers, talk to a number of different end investors that are really asking some serious questions about this industry. We see the responsibility for long-term savings continuing to shift from the government to the employers to the employees. That's driving a different product set, a different mindset, a different need from the investors. But on a worldwide basis, we see some of the big stakeholders of this industry really asking the question, what's the value for money of financial advice and active management? And we see that from politicians, regulators, media, trade associations, asset owners on a global basis. From Australia, where there's a significant Royal Commission review going on right now, to Europe, some strong EU directives, MiFID II, in the UK, a competitiveness review, and even in the US, under the Trump administration, they're still focused on the best interests of the end investor. So some significant challenge to the overall value for money of this industry. And on a global basis, we see fees compressing, operating margins under pressure, people really questioning how much is this industry charging, and is it delivering the right result to the end investor? Of course, we see economies of scale, and here in India, it is no different, where we see the largest managers continuing to gather most of the assets, a real concentration in the winner takes all. And of course, with the development of new technology, we see asset managers really starting to look at new ways of making their investment decision. I'll talk much more about that as we go through today's presentation. And of course, the retail investor looking at educating themselves, gaining advice, executing their transactions through digital channels. A real shift in the world in terms of the way in which investment product is bought and sold. And of course, increasingly, investors are not only worried about the financial return of their investments, but also the non-financial return. Is it doing the right thing for society? And ESG, of course, is becoming an important global product. So how is the industry responding to some of these real structural changes, some of these challenges to our industry? Well, of course, digital disruption will undoubtedly be part of the response. And digital disruption, the new digital technologies, are really starting to disrupt the entire value chain of our industry. From the way in which products are sold or bought online through a variety of channels, particularly in terms of the way in which investment advice is delivered, all the way from robo-advisors to hybrid advice, really augmenting the humans to provide a higher quality experience for the end investor, whether they are ultra-high net worth or mass affluent. And then, of course, in the investment decision-making process itself, which I'll focus on for the rest of this presentation. And then there are digital technologies to make this industry much more efficient. Of course, robotics is one of them, blockchain, distributed ledger another, a real generation of technology to make this whole value chain more efficient, to reduce the costs, to reduce the TERs for the end investor. So some significant change, and undoubtedly artificial intelligence will form part of that. So now let's zoom in on big data and artificial intelligence. What is it, and how is it making investment decision-making different in the future? Well, of course, big data refers to a wide variety, a whole new universe of data that can be used to make an investment decision. And of course, that huge universe of data requires some complex analysis before an investment decision can be made. That's the machine learning or artificial intelligence and how that's used to process and to analyze that new data set. And of course, as a result of some of this new alternative data, what we're seeing is the traditional data sets that many of you have used to make investment decisions in the past will start to lose their power as this alternative data starts to predict those traditional data sets with much more accuracy. It will become the new norm. And I believe, and as I'll go through today's presentation, I'll try to convince you that artificial intelligence and alternative data will indeed be a part of all decision-making as this industry continues to proceed. So, let's take a quick look at the process for adopting alternative data and machine learning, artificial intelligence. Of course, it all starts with some form of data extraction. It's about collecting as much data as possible. It's about extracting that data in a way in which it can be analyzed using different artificial intelligence techniques, then processing that data, starting to really interpret that data, look at correlations, look at patterns, do things that humans find very difficult or take a huge amount of time to do. I'm really looking at that data and the performance of that data and its predictive power to make an investment decision. It's then scoring each of those assets to look at the sustainability and the persistency of some of those signals. And then ultimately, it's about pushing them into a model to create an investment decision. Most importantly about these new techniques and this new process is the continuous feedback loop. The machine learning algorithms continually challenging the data sets that are being collected. The data sets continually informing the machine learning algorithms. A continuous loop that makes this decision-making process get better and better over time. And that's an important part of how we see artificial intelligence starting to change investment decision-making. So, why are we seeing some of these new techniques that we'll talk more about in a moment starting to rise to the surface on a global basis? Well, there are three main reasons why we see much more focus, investment into these types of areas across the largest asset managers in the world. Firstly, there's been an exponential increase in the amount of alternative data available for asset managers to use, to interpret, to make investment decisions on the back of. Secondly, of course, the well-documented rise in computing power and data storage capacity, of course, key prerequisites to using these types of techniques when making an investment decision. And of course, that type of capability much more available at a cheaper cost. And lastly, the advancement of machine learning techniques to analyze these complex data sets. And not only the advancement of the techniques, but also, I think, the number of resources that are available to you as an industry to actually use some of these techniques in investment decision-making. Lots of my clients on a global basis are hiring data scientists straight from university, straight from other industries, into the investment world to help make a higher quality investment decision. So let's start with a few definitions. So what is big data and why is it different to traditional data? Of course, it's larger in volume, velocity, and variability than traditional data. It comes from a number of sources, both at the macroeconomic level as well as at an organization-specific level. It comes from individuals, of course, social media in particular, but your electronic footprint is being captured on a global basis. It comes from processes, and it comes, for example, transactions in the commercial world, and it comes from sensors, i.e. pollution, or satellite-type sensors. So this alternative data is being generated on a global basis with a huge amount of velocity and a huge amount of volume. And what it's doing, it's shifting from experts gathering traditional data from management companies themselves to really giving the availability of this data in large quantities to all asset managers. And of course, it's enabled by certain techniques like natural language processing and optimal character recognition. Two types of techniques to enable people to interpret huge volumes of data very quickly without the need for humans to be involved. And of course, when you look across the world, there are a number of fintech providers providing this type of alternative data to people like you. That data coming from satellite imagery, social media platforms, price and economic data, location data, and of course there are also fintechs aggregating all of this information. We work with a number of new startups that are providing 80 to 100,000 data points on a daily basis of alternative data to their asset management clients. A unique platform that provides and complements the traditional data set with these types of alternative data sources. And of course we see big asset managers, and this is a great example from BlackRock that they use publicly about how they are trying to analyze and decipher that information. They're taking some of their algorithms, they're taking the natural language processing type machine learning to really understand all of the analyst reports that are produced, so traditional data set, but applying a machine learning technique, really using those NLP algorithms to understand the sentiment analysis from these investors. A much faster way of interpreting some traditional data sets, really looking at what economic signals they can derive from that type of sentiment analysis, and really looking at how that will generate a buy or sell signal within their portfolio. So a very simple example of machine learning applied to an alternative to a traditional data set, already well documented and used by BlackRock. They have globally announced that they have reduced the number of research analysts, the number of portfolio managers as a result of using these types of techniques. Not only is it making the process more efficient, it's taking out cost, it's leading to a higher quality alpha decision. And then when we talk to some of our leading hedge fund clients and ask them, are you using these alternative data sets? You'll see here about a third say, yes, we're using these alternative data sets already today. Almost another third saying, we're going to be very soon. So already the hedge fund community in particular really embracing alternative data as a key source of investment decision making and alpha generation. And then some of the most well-known asset managers in the world, even some of the passive managers like Vanguard, Schroders, BlackRock, Goldman's, I'm sure I could add some Indian names to this as well, are really starting to embrace alternative data as a core part of their investment decision making. You'll see here that BlackRock say, we believe that in order to generate sustained alpha, investors should embrace acquiring, analyzing, and understanding the fast-growing universe of data. Those who are unable to do so run the risk of falling behind in a rapidly changing investment landscape. And that's a quote directly from Larry Fink, really talking about the future of investment from a BlackRock perspective. So once people have gathered this huge amount of data, of course, the next question is, how do I analyze it in order to make a high-quality investment decision? And of course, we see a number of different artificial intelligence tools, from very rule-based all the way through to deep learning techniques, to really try and apply algorithms and analysis to this huge universe of new data. And of course, when we look at some of the different interpretations or the different characteristics of these techniques, we see that there are different data needs for each of these techniques. So some of the more machine learning data needs are much thinner, not necessarily needing a huge universe of data, very much a more linear approach to machine learning, whereas some of the deep learning techniques requiring a very broad universe of data. The actual hardware requirements, the actual processing capacity required for deep learning is significant, but not so much for the machine learning type approach. Of course, the problem-solving nature of these techniques also differs. So machine learning typically looks at a problem and breaks it down into bite-sized chunks, whereas the deep learning type algorithms really looks at this in a holistic way, really tries to absorb all of the data and the nature of the process and generate an answer to the entire problem. Requires much more processing, requires much deeper thinking, much longer time, but generates potentially outcomes that humans could not even think about. And what we also see is, of course, the interpretability of some of these techniques. It's much more simple with some of the machine learning techniques to understand why the algorithm generated the decision. What we see in some of the deep learning algorithms, it's very hard to find an audit trail to truly understand why the algorithm created the decision. And of course, that creates a problem for investment managers when having to defend their approach to their client base. And of course, is one of the challenges to the industry embracing these types of techniques. So how are asset managers approaching this alternative data machine learning? Where do you start? So we're seeing three approaches being used on a global basis. Of course, on the left-hand side, really the lightest approach, which is really trying to take what we call a fully outsourced model, really relying on third-party research to provide this type of insight. So subscribing to buy-side or sell-side research, subscribing to providers of these algorithms, really not having much expertise in-house, but trying to absorb some of this analytics as part of the decision-making process. It's cheaper, but of course it's very limited in terms of exclusivity and the ability to generate alpha. I guess the partially outsourced model is the first step that many of the asset managers that I work with are taking on this journey, where they are actually purchasing some of this raw data from some of the providers that I referenced earlier. It's then looking at some of that data in a semi-processed way, maybe using some of those techniques like NLP or OCR. And then it's starting to generate some sort of trading algorithms from some of those machine learning techniques. It could be that those algorithms are generated by third parties, and they're working with some of those experts to use those machine learning techniques as part of their investment decision making. Then, of course, the deepest pockets, the areas, those hedge fund managers, maybe some of those quant managers that have been focused on these types of areas for some time, are really looking at fully internalizing this whole process, from acquiring and generating the data themselves, all the way through to the storing and collection of that data, through to creating proprietary signals and trading on the back of it. And when I meet with some of my largest hedge fund clients, they're really at this far end already and are investing tens, if not hundreds of millions of dollars in this space. So let me give you an example around how do all of these techniques come together to really re-engineer the investment decision-making process. And here's an example, a case study from one of our clients. We worked with a very large asset manager to really understand the three different levers that have to be optimized to generate alpha as a result of some of these techniques. So the first area was really to increase the breadth and depth of data universe coverage, to generate more ideas to go into the investment hopper by really looking at alternative data sources, finding a way in which they could process that data to really open the minds of the investors to a much broader universe of indicators. And we spent a lot of time helping them understand the alternative data sources, a way in which they could then process and clean that data to enable them to move on to the second stage, which is really trying to reduce the time to idea to capture alpha earlier on in the process, to really take a leading edge over their competitors. And we really worked with them to build algorithms using some of those machine learning techniques I referenced earlier to really start to process how valuable each of those assets were, how predictive those particular alternative data sources were, try and identify correlations and patterns to really generate a high-quality alpha decision. And then it moved on to the third stage, which is then automating the way in which those signals are embedded in the portfolio construction process and ultimately into portfolio optimization. So we worked with them throughout the process to really try and re-engineer the investment decision-making value chain. And then that's leading asset managers to think about, well, what is the future of investment decision-making? Will it be that ultimately the human-led approach that we see most commonly today will be augmented by these types of algorithms and this type of data? Or will it ultimately be that investment decision-making becomes artificial intelligence-led and just supervised by humans? A whole new world of investing. And of course, there are two very different philosophical views about the future of artificial intelligence in our industry. I think it's most likely for me that, of course, the first few steps will be the augmentation of the human process, really helping create new ideas, generate new thinking, for the fund manager, the portfolio manager, to consider as part of their traditional process. And that really continues here to the augmented approach. But I think already we see down at this end the next evolution of quant models, the next evolution of maybe smart beta or factor investing using a much more sophisticated version of artificial intelligence to generate some of those investment decisions. This could well be the future of our industry. So what are some of the technologies, some of the techniques that are available out there? So you look at this slide here, this graphic, and you see here there's a number of different techniques used to process structured and unstructured data. as part of really understanding the data that's most relevant to investment decision making. And then, of course, we move to the analysis of that alternative data, sentiment analysis, impact analysis, really looking at some of the different techniques available to really use that alternative data and to use that as part of the decision-making process. Then we get on to some of the automation of the intelligent analytics, really helping interpret and embed that type of decision-making into the algorithms, then ultimately onto optimizing the portfolios. So a lot of data and a lot of techniques already available, a lot of technology already available to help with each stage of this new investment process. And of course, many asset managers are not only embracing alternative data, but really already embracing artificial intelligence. Here are just a few names to really show how this type of technique is already being embedded in the way in which they manage money. And of course, when I go and see Man Investments, a very large London-based hedge fund, they say to me, Alex, we've been using these techniques for 20 years. It's just a natural extension of the way we do business. And they are surprised that many asset managers are still questioning the viability of this new type of process. I think you can see there a very interesting quote from the CEO of Man saying machine learning helps us spot patterns that humans can't easily spot or couldn't spot at all in the sheer amount of data being created in the world today. And of course, that really is at the heart of what this new process is about. So, does it all make any difference? What does it look like in terms of alpha generation and investment performance? Now, of course, you can find data to justify any point, and this is the data that I use to really look at the interpretation of the outperformance that has been generated by some of these techniques. So many of you will have heard of the Eureka Hedge Index. Eureka Hedge have also created an artificial intelligence machine learning hedge fund index to really compare the performance of hedge funds using artificial intelligence as part of their investment decision making versus those hedge funds that are taking a much more traditional approach. And you'll see here that over the 1, 3, 5-year period, those hedge funds that have embedded some form of artificial intelligence have significantly outperformed. Now, of course, you could easily say to me, well, Alex, in the last 5 years, we've been in a global bull run. Typically, we've had low volatility. There hasn't been a huge market dislocation, and therefore, it's not surprising that quant models using some form of artificial intelligence have performed extremely well. And of course, that's true. And time will be the true test of the persistency of this type of technology. But from the data that we do have, you can see that there's already some significant outperformance being generated by the hedge funds that have incorporated some of these new techniques. So, what does an augmented investment approach look like? So it's about gathering the data, it's about the automated collection, it's the interaction, it's about augmenting the portfolio managers, the research analysts with some new ideas. A first step on this journey. It's an augmentation approach. It's been able to quickly interpret the new vast volumes of data, both traditional and alternative. It's then about using algorithms to help the portfolio manager factor in some of these new ideas into their decision-making process. It's about testing those ideas with regression analysis to really see whether there is persistency and predictive powers of some of these assets. So this is a typical value chain when these types of techniques have been used to augment the portfolio manager and the human-based team. It's a first step in the journey. It could be your first step to embedding some of these techniques into your investment decision-making process. It's a small step to being able to really augment the alpha generators that you have in your business already with some of these new techniques and some of this new data that is available to you in the market today. And then, of course, it may end up with a fully AI-led investment model, where, of course, the deep learning algorithms are continually learning and questioning the data, continually seeking new data sources to generate a whole new investment process. It becomes an algorithm that starts to take on a life of its own, continually reassessing the quality of those signals, continually reassessing the persistency of the alpha generated from some of that alternative data, and then goes all the way through the investment process to automated rebalancing and optimization of portfolios, identifying the best way to execute those proposed trades, and continuing to reassess the value of the model. And this is maybe a stretch too far for some, but in the future, this is how we could see investment decision-making looking. Definitely a much cheaper approach, and possibly a much better approach to generating alpha. It's contentious. We're probably many years away from it, but this could be the future, and this is what a number of asset managers are looking at. How could you fully automate the entire life cycle of investment decision-making? So I guess the key question for many of you will be, well, will machines replace investors? Now, of course, when we look at the market today, we see some of the high-frequency trading that is available, and there's actually very little human touch involved with some of those high-frequency trading models, almost fully automated already in today's world. But of course, when we think about long-term investing, it's a very different discipline, and it's probably, in my impression, highly unlikely that machine learning is going to fully replace humans for a long, long time. So why do I say that? Well, of course, when you actually start to work with some of these techniques, what you realize is there is a temptation from the algorithms to really try and overfit the data. There's a temptation to create spurious correlations and patterns. And of course, it's difficult for the human to really understand why the model has generated some of those investment decisions. We see, of course, today that they've not performed as strongly during significant periods of market turmoil, where we see some of the changing macroeconomic assumptions. That's when these types of techniques struggle. And of course, ultimately, it's difficult to integrate some of these techniques with the traditional investment process. And we see a number of these leading asset managers hiring these data scientists, but still struggling to make 1 and 1 equal more than 2. They try and embrace the data scientists and some of the people who've got expertise in these areas with their traditional portfolio managers. So there's clearly a number of limitations currently to the ability of these types of tools to fully replace humans in the investment decision-making process. So, how do I bring all of that together? How do I conclude? Well, starting at the beginning, it's clear that the stakeholders of our industry are continuing to question the value for money of active management, both in terms of the alpha that's generated and the cost that that alpha is to the end investor. And of course, here in India, you've had some fantastic performance for many years, but it's likely markets will become more volatile, generating alpha will get more difficult. When we look at the world on a global basis, active management is finding it difficult to justify the fees that it charges and finding it difficult to justify its performance over some of the smart beta investing we've seen proliferate over many recent years. And of course, if the stakeholders are questioning the value for money of the industry, then achieving the investment objective, achieving alpha generation, becomes increasingly important and much more transparent to all investors, both institutional and retail. And as a result, of course, we see fees continuing to be challenged and operating margins falling. So given that type of context and the opportunity to use big data and artificial intelligence, because of the availability of the data, because of the increased computer processing power, because of the advancement of some of the machine learning techniques, the ability to embrace that to address not only the efficiency and cost of the process, but also the quality of the process, means, in my opinion, that ultimately big data and artificial intelligence will be used to augment almost all investment decision-making. But of course, this is the beginning of the journey, and therefore the first movers will undoubtedly gain a competitive advantage as others are slow to respond. I'll leave you with that thought. Thank you.